Hey, welcome to the podcast, everybody. Thanks for joining me. Appreciate it here on this Thursday afternoon, a big day after the bell. And let's take a look at what the market did today. Kind of bounced around the flat line most of the day. Of course, the Dow was up about 70 or 80 points earlier in the day after being down for several days in a row. And then it went negative at one point. There was some downgrade rumors, and then it managed to eke out a 26-point gain, 13,103 on the Dow. The transports, which have been just all over the map, they were up 60 basis points to 5,035. You can see the oil equipment and services index was up pretty good today. Semiconductors up pretty good today. Mid caps and the Russell 2000, kind of in line with what the market did overall. S&P up about 30 basis points to 1412, and interest rates rose quite a bit to 1.8%. And so we've got a lot to cover. Let's jump right into it. All right, let's start off with the S&P 500, and of course we'll get to the earnings in just a minute. But really, since the last podcast, at that time I was saying let's just continue with what's working until it doesn't work. And what was working was pretty much everything across the board was working pretty well. I mean, healthcare was doing well, gold was doing well, financials were doing okay. And now what you have seen is, and a couple people have pointed this out, and it was, we talked about it in the last podcast, that we kind of had this double top, maybe even a triple top if you have the little lines here going that way. And so now we've clearly broken, this uptrend that had been in place since June. No doubt about that. And, look, the market was overbought at that point, but it was overbought at previous points even before. And then we had these big jumps. We had QE3 announced. And so it was kind of like, hey, how can you bet against this market? So it was challenging because it was overbought, yet it kept going up. And that's sometimes what happens. Overbought markets continue to get more overbought. But now that it's working it off, and it actually had been working it off without really going down dramatically. But in the last few days, of course, the market has gone down. And yeah, it was up 4 points today on the S&P, but for the most part, it's been in this downtrend. And of course, people have pointed out that it broke its 50-day moving average, which is, kind of a big deal, even though it was bouncing around back here in April across it several times. And same thing in July. So yeah, I guess the shape of it is the bigger picture, and the fact that it's flattening out is a bigger concern. But it seems to me that we're still in, I would say, if you're somebody that trades every day and you're really short-term in nature, then yeah, you should have been selling or making some moves or shorting or whatever, because things look like they potentially were setting up for this double top. But I would say for those of you, and probably most of you, who are more medium term, some of you may even be longer term, there is nothing that has broken its let's call it the pain threshold, the threshold that says, okay, something is really different. I really gotta change what I'm doing. Nothing has done that. Now, last summer, a lot of things changed very, very quickly, much faster than they're happening now, and they were much, much bigger. In fact, if we zoom out here and we go to last summer, look at the end here. Look at this little drop we're going through compared to this drop. Not quite the same, is it? And of course, we had just tremendous volume down here back then. You look at the volume now. So it's not the same intense type of sell-off. It may feel the same at times, depending on what you own. If you're somebody that owns some things that are falling, like find out that Monster Beverages drinks allegedly may be contributing to the deaths of some people, and the stock has just been killed. And so if you're somebody that owns those types of things and you go for 80 to 40 in 3 months, you have 50% loss. Yeah, that's a huge deal. If you come back to the S&P and you look at the S&P, what it's doing now compared to last summer, it looks more like a correction. And again, some of the longer term things that I'm looking at don't seem to be suggesting that, hey, this is the thing you should be completely shorting into. And it may turn into that. It's too early to tell. But the thing is, again, and I've said this before in several podcasts, if you're positioned where you have all of your eggs in the basket of stocks and you don't have any cash, then yeah, that's your position incorrectly. I think how you should be positioned, and we've talked about this several times, is by having some things that benefit from a falling market, having some things that benefit from a stronger or weaker dollar, having a lot of income, having some cash. A lot of you hate to have cash, but cash is when this correction ends, is going to be used to buy the things that you've been wanting to buy. So again, if you have this multi-strategy, then you can sleep at night and you can navigate through this. Not that you're going to come away unscathed, but that when you see the transport's down 2% one day, you don't look in your account and say, whoa, I'm down 2%, because you have these other things that are offsetting. There's a lot of income producing things that are still going up right now and doing quite well. So you have to own a little piece of these different things, and that's what real diversification is. It's not just owning a bunch of different things. It's owning things that yin when other things may yang, and how correlated are they to each other. That's what diversification is. But if we look at the S&P, what's been happening now, and I think this is very, very important, the reason that the stock market is selling off, I think, is a few things. Number one, it was overbought. It was just extreme when you look at some of these different oscillators. If you picture it like a clock ticking or a pendulum, it was just pegged to one side a little too much. And so it was coming in a little bit. That was number one. Then what was expected was weaker earnings. And those earnings have been weaker than even the weakest estimates. It seems like company after company after company is saying not only are we missing our earnings estimates, but we're also missing our revenue estimates too. And that's what happened last quarter, if you recall. A lot of companies did okay on the bottom line. Management was able to move some coconuts around and make things look a little better than expected, but they can't lie on the top number. How many sales do you have? And that's where it really was a little misleading last quarter. However, the market kept going up. Why did it keep going up? Because of the hopes of QE3, which we got right in here. Now that has happened, buy the rumor, sell the news maybe, but the same thing seems to be happening this quarter, where companies are coming out and they're saying, hey, things not only did we maybe come in line with estimates or a little bit weaker, but on top of that, our revenue was weaker. And going forward, when we look out in the future, you analysts need to lower your estimates, because it's not as good as you think it's going to be. And so that's just too much for the market to overcome. There's one other component here. And of course, this is something most of you have been asking about for months. How will the election affect the market? Some of you thought if one candidate wins, it will go one way, and if another candidate wins, it'll go another way. Not going to get into politics on here, but the bottom line is that if you look at what's happening, take a look at the coal stocks. Okay? Now, coal stocks have been beaten up, right? This is the KOL, which is the ETF for coal stocks. We look at the coal stocks from top to bottom here, 55% decline, okay? And that has been because the current administration is basically killing the coal industry. And I think what's been happening here lately, as Romney's numbers have been getting better in the polls, you have been seeing coal stocks come to some life, at least bottoming. And so that is something that I think that's directly contributed to what's going on with the election. There's something else here. Many people feel that the dollar will be much stronger under a Romney administration. So if you look at what's been happening, as Romney's numbers have improved a little bit in the last several weeks, the dollar has perked up a little bit too. It's gone from about 78.5 up to over 80. And as you know, a stronger dollar typically is a weaker stock market. So it's kind of an inverse. So those are three things that are causing this kind of volatility. And we knew that volatility would rear its ugly head at some point, and now it's starting to a little bit. And volatility is not crazy right now. It's really not, if you think about it. We've had a couple of bad days, but for the most part, it's been gyrating with a general trend downward. I kind of sound like a weatherman. We've had a general trend downward here. But really, we've had 2 bad days. Outside of that, it's just been kind of working its way down a little bit. So it's not in panic mode like last summer, but it's in something that gets your ears perked up to say, hey, do I need to make some adjustments? What is my portfolio doing on a day where the market's down or up? And then you make modifications to that. And I think that's the best way. And again, keep the income coming in, because when the market does gyrate back and forth, you still have the income coming in on a consistent basis. So that's very important. But those are the things I think that's causing this market to pull back a little bit. And the question is, again, where does it stop? That's the main thing we want to try to figure out. And look, I think the 200-day moving average is going to keep doing something like this. It's quite possible that the stock market works its way down there. and ends up coming down to here. If we look at these Fibonacci retracement lines, coincidentally, the 200-day moving average is right at about 50%. For those of you that don't know what this is, you basically take the low of the recent move up to the high of the recent move, and what it's saying is if we were to come down to the 200-day moving average, coincidentally, that would be about 50% retracement, meaning we would have given back half of the gains of this June to October high or September high. So that is a spot that's in play, and that may be in the high 1300s. And we may get that tomorrow, which leads me into, perfect little segue, to Apple and Amazon. Both of those reported earnings tonight. Amazon, as you can see, was already in a little downdraft here. And after the bell, Amazon basically missed estimates. Just really surprised me because as much stuff that's purchased on Amazon right now with the smartphones and the tablets, you would think Amazon would be dominating, but it's not happening. And somebody commented to me a few minutes ago that they get a lot of stuff on Amazon for free, and it's not a great business model. And don't forget, places like Texas, we now have sales tax. So when you buy something on Amazon, that competitive advantage isn't necessarily there anymore like it was. But generally speaking, I still like this stock. Not necessarily the. Let me rephrase that. I like the name brand of the company. It's a high valuation, very expensive stock. And when expensive stocks miss earnings estimates or disappoint, the stocks get crushed. And that's what you're seeing happening. Now, Amazon was trading down, I think 8 or 9% immediately following that release. It's now trading down about $10 to roughly about $219. So that's going to be right about here. If it was to open up tomorrow, where it closed, it's just down a little bit. So it was down quite a bit, and then it came back after hours a little bit, but it's still above its 200-day moving average. Some people may feel it's priced in already because remember, these stocks have been falling already coming into this. So, and that's very important for those that are new to this. Why is the stock going up if it reports something bad, or why is it not going down as much as you thought it would? It's because a lot of this was in fear of a bad number, and then it's confirmed. And once it's confirmed, the unknown becomes known, and the stock could potentially bounce. And that's the same thing with Apple. They missed earnings estimates, but you already have a lot of the best analysts. I know it's not an oxymoron. There are some good analysts out there, but the best analysts out there saying, look, who would on earth would be buying an Apple iPhone 4S coming into the launch of the Apple iPhone 5? And so what happens is, and this is something we've heard before, but Apple's very good at coming out with these new products, but the iPhone 5's coming out, so demand is very soft coming into that launch. So it's kind of, hey, they had a weak quarter last quarter, but it's going to be very strong this quarter because not only do they have an iPhone 5, but they're going to be having the Apple Mini, the iPad Mini, and then they have a whole new line of Macs, which I'm actually going to go buy a new Mac. I've been needing one, and now this new Mac, iMac, is ultra thin. It does some very cool things. It has this hybrid hard drive in it, part flash, part regular hard drive. Very cool, very fast. So I think I'm still bullish on Apple. I own Apple, and it's something that I don't look at the charts on a day-to-day basis and say, should I be trading at this level and buying it back here? Some people do that. I just think Apple is still a dominant company, and it's not a terribly expensive company. The only caveat to that is Apple is such a cult stock. It is something that everybody has to own, and everybody does own. And so when people start selling it, it starts to fall. But remember, again, just like Amazon, it was at $700. It's trading at around $600 this evening, so it's already fallen, $100. Or if you were a $70 stock, it went from $70 to $60. And so now it's priced in. But again, I think they're going to have a huge Christmas. Part of the other issue is that they've been having these supply issues, and where they couldn't get the product out fast enough because of problems in theher plants. They're moving to more technology to put these phones and these devices together without humans, which is a whole other podcast to do on the structural employment problem we have in this country, which is basically robots replacing humans. But if you think about it, I actually went to buy an Apple iPhone 5. This is what happened to me. I went to buy an iPhone 5 because my wife needed a new iPhone. And she said, you know what? You like all that fancy technology stuff. I'll take yours, which is mine's a 4. She said, I'll take yours. You go buy the new iPhone 5. I said, great. So I go online, and it says, hey, you can come back at 10 p.m., and you have from 10 p.m., I think, till, I don't know, 2 a.m. or 4 a.m., something like that. You can buy them online, and we'll have them the next day in the store. There's only a few available. I tried literally for a week. Right at 10 p.m., was never able to get one. So my wife ended up going to get a new iPhone 4S. She got the older version. And it amazed me because that was an actual sale that didn't happen for the iPhone 5 because I couldn't get it in time. And, that's a negative to the earnings this quarter, but it's also positive in the sense that there's demand that they couldn't meet. And that means that it will probably be met at some point. I mean, some point I'll get another iPhone. So you have those things going on with it. I mean, look, it's still a cheap stock. It was maybe a little, it had gone from $530 up to $700 in a straight line from June to September, and now it's pulling back. If we look at this on a longer-term basis, and I've talked about this before, this long, what is this, the 50-week moving average right now is at $550. So, I mean, if you're somebody that's owned this for a while and you're saying, hey, until something major changes, I'm not selling it, the thing that would cause me to reconsider a major change would be, A, something fundamentally wrong with the company, or B, that this long trend changes. And I don't see that. What I see right now is it made a big burst up, and now it's kind of, for the most part, moving sideways a little bit, even though you're getting these big, daily moves. And again, if it were to break that long-term moving average, that would be something that maybe that's a change in character. We're not seeing that just yet. But what it is going to do is it's going to have an effect on the Qs tomorrow. It's going to have an effect on the S&P 500 tomorrow. And those are all things that could fall. Sorry, these are weekly pictures. This is a daily. Those are things that could fall because of the fact that, you have Amazon basically with worse earnings, and you have Apple with worse earnings. And so that combination obviously has this effect of trickling down, right? Then maybe the suppliers get hurt, maybe all technology gets hurt. So we'll see if it hurts the overall market, but keep in mind that Apple is such a large part of these indices that it affects it quite a bit, especially on the Qs. I think it's 20% or something like that. And Apple's got a huge amount of cash right now. But these companies Apple's such a big part of these indices that it affects it. So the Qs are sitting right at their 200-day moving average. And again, that's another, sign for people who go, this is something that, again, what are we looking for, a change in character? Well, hasn't broke the 200 since, last year, called 2011. And so again, for longer-term people who look at this and aren't real technical or day-to-day, one of their warnings is the 200-day moving average. So when it crosses that, you go, it crossed the 50. Now it crossed the 200. Something major's going on. But I'm not seeing the intense selling just yet. We haven't seen the real panic selling. We've seen a couple of days of that, but we haven't seen, 2 or 3 or 4 days in a row of those. We haven't even had a 90% down day. Those 2 bad down days we've had haven't been 90% down days where you get basically every stock going down, all the volumes down volume. We haven't had those yet. So the fear hasn't really escalated. So from that standpoint, we could have a little further to go. But again, in the little longer term, not seeing huge structural damage just yet. But we do need to be cautious of this because, remember, last summer things started to escalate very quickly. And we do have the election coming up. And so, again, we have some unknowns. Now that Romney and Obama are, depending on which poll you look at, essentially tied, and it's maybe a toss-up, that is now a big unknown, whereas maybe a few weeks ago, even though you may have your own opinions about whether President Obama should get reelected or not, at least it was a known, and the market felt comfortable with, hey, at least we know we're dealing with this. And now they're going, we don't know, it's a big fork in the road, whether Romney gets elected or Obama. So now it's a real toss-up, and the market is acting as if it's a toss-up. And then you throw on top of that Ben Bernanke's future. Helicopter Ben may not be there for the market, and investors are starting to go, free money gets taken away. What would we do then? Then we have to rely on earnings. Well, earnings aren't very good right now, and the economy is mediocre, not great. So the stock market is questioning that and struggling a little bit. So those are all the things happening right now. And again, you just got to navigate your way through this. But I wouldn't necessarily sit there and go short the market right now, be in all cash, because We saw a rumor the other day, and the stock market rallied back and finished flat on the day when it was down quite a bit because of some rumor. And I'm not saying that's good. I'm just pointing out from somebody that owns investments, that if you're short, all it takes is one rumor, and all of a sudden you get your face ripped off. So be careful about that. So sometimes using cash instead of shorts is a better method. All right, let's take a look at interest rates real quick. And first we'll look at the actual rates themselves. And if you look at this picture, you go, yeah, it looks like it may be turning the corner here. And I'd been having trouble at this 200-day moving average. And this is the 10-year Treasury, so 1.8% on those. And it had been kind of struggling there, and maybe it was going to turn the other direction. If we look at the TLT, pointed this out the other day that on a blog that we were potentially getting this inverse head and shoulders. And this is the shoulder, head, shoulder, and maybe we were going to break on through and go on up. And since then, it's had trouble and started to break through, and then it's kind of come back down, and now it's meandering. But it does look like it could be rolling over. And what's interesting about that is that you would expect that in past times when the stock market was struggling, treasuries would be going up. That's not happening right now. And so if you're somebody that's been using treasuries as a hedge, be careful about that, because sometimes these hedges, a perfect hedge is cash, right? You just sell the instrument. That's a perfect hedge. So if you're selling stocks because you're worried and you're rushing in to buy treasury bonds, be careful, because you see here they were actually down today. Now the market was up a little bit, but for the most part, a lot of stocks were down today, and you can see TLT was down as well. So just interesting to watch that. So keep an eye on that. But if you're concerned about stocks, sell the stocks or short the stock market. Don't necessarily go rushing to buy treasuries, because sometimes if that correlation breaks down, there you are, you get stuck. All right, everybody, have a wonderful evening. Thank you very much for joining me. Don't forget carleggers.com, twitter.com/Carl Eggers, or on Google+, Facebook. There's eggerscapital.com is the money management website. And appreciate you viewing.